It is Wednesday, January 29th, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very fun get your ass kicked at Jiu-Jitsu Wednesday. Certainly did get my ass kicked, although I think I kicked a little bit of ass too. Yeah, we did a lot of stuff from the butterfly guard today. And I happen to like the butterfly guard quite a bit. Although the thing that we were doing that I was having the most trouble with was a sweep. And for some reason I was having a lot of trouble getting it to where I could get both of my feet from hooking under my opponent's hamstrings on it. Because apparently for this particular lift, or sweep or throw, or it's kind of a sweep and a throw and a dismount and all kinds of good stuff all in one. But anyway, I guess you're only supposed to be doing it with one foot. But honestly, I felt like doing it with both of them, I was able to keep a really good structure. But I can see if I were to do just one foot, lifting with just one foot, lifting my opponent with one foot, and this is from a butterfly hook kind of thing. If I just lifted up on one side and pulled my opponent's arm down, so like if I had like a hold of their right sleeve and I pulled it down with my right arm, and then I grabbed their belt, right, and then hook the that would be the left hamstring with my right foot and just kind of kick it over. And like I said, I could see that one in particular working that way, although I was doing something a little bit adjusted from what the instructor had told us to do, where, like I said, I was putting both of my feet and hooking both of my feet at the same time. And like I said, it for whatever reason, it felt right to me, but I don't know if I could actually get that on somebody, and that was the thing that we were testing today, or at least I was making an effort to try and test some of the stuff that we were covering in class today. Like, we covered this one armbar, and I've got kind of a love-hate relationship with this one particular armbar. I've gotten it once or twice, but it's in a gied situation. It's not as easy to see where the elbow is, and it's really important where you line your elbow up with your opponent's elbow to kind of get a gable grip there, and then swing your elbow down with the back of their forearm up against your neck, and you get it in the armbar that way. Like I said, I've gotten it once or twice, but it's been one of those things where I just got really lucky. It's like it was right there. I just reached over and I could see where their elbow was, and so I pulled his arm closer to me by kind of pulling him in with my grip. I did it from a full guard position as opposed to a butterfly guard position, where I had both my legs wrapped around him, and so I was able to kind of control him a little bit better in keeping his distance really tight to me there. And I don't know, I think that helped in that I was able to gauge, keep him right where that elbow was available to me for that armbar. And so then I just had to bring my arm up in and then bring it back down again over his arm and get that gable grip, and then rotate the elbow in. But anyway, so a lot of good stuff today. A lot of good stuff. In the last 10 minutes, we've been doing a lot of fucking rolling lately. And I can only suspect that they're prepping us for possible promotions and just really trying to get an idea of where we're at with our jiu-jitsu. And I tried to take it easy today just because, I'm still injured. However, the coach did mention that he wanted us to be rolling the full 10 minutes of the round. And it was just a single 10-minute round. And so I did manage to last the entire time. And think my opponent got a submission, and I kind of half gave it to him, but I mean, he earned it. He got the position on his own. I didn't like guide him into it or anything. He got the armbar exactly how he should have. But yeah, I did feel kind of guilty because he's a little bit smaller than me. He's quite a bit younger than me. And so, there's the experience differential and the weight differential and the size differential and the strength differential. But I like him a lot because he doesn't let that shit get in his way. It's like I've had this talk with several people that are smaller in stature with regard to jiu-jitsu, and there are advantages and disadvantages to every body type. And it's not going to be easy for you against everybody, but there are things that you only learn by going against people that are much bigger than you with regard to how to deal with it. I mean, and I'm on the upper end of it, so there's fewer people that are past me as far as size and whatnot, but I'll tell you what, the people that are above me, a couple of those people are killers. So it's like, I actually fear the people that are smaller than me more. And the reason being is because they're things like distance for their legs, things for distance for their torso, and their arms is shorter. This means adjusting their position and orientation to mine is much easier. But, of course they have to use frames a lot better. And they definitely have to be up on their frames. Otherwise, I'm squishing them, I'm rolling over on them, I'm putting my knee on their belly. They got to know their frames. And, so like I said, I had quite a bit of fun rolling with him today. And I got him in several submissions. I got him in I think I got him in a Kimura. I don't think I got him in an armbar. I think I tried to get him in an armbar, and I messed up with that, and it was that one particular armbar. And I got him in a arm triangle. I thought about going for an Ezekiel choke, but I caught somebody with one of those on Monday, as a matter of fact, and that was fun because you end up in that position quite a bit, but the thought to apply the Ezekiel choke isn't always the first on your mind. And so I acted like I was reaching back down for his collar, and then I just grabbed my sleeve and then pushed the arm all the way through. And it was like, oh wait, that's a choke too. Oh shit. But yeah, and I did get one other choke today that was like, it was one of those where I really shouldn't have gotten it because I was within his guard, but I got him in a full-on zipper choke. But yeah, I stacked him, and I leaned down, and I think he was reaching for one of my feet or something, and I dropped to my knee when I kept him in that position, and then just zipper choked him. But I mean, that's one that people really should not get you in. If you've got somebody in your guard, they should not be getting collar chokes on you. That's like, it's a big no-no to even try, because your opponent can just grab your arm and put you in a fucking armbar or triangle. Oh yeah, and that was another one I got. I got a triangle on him too. It wasn't a conventional triangle either. I had to go kind of to where I was more sitting on top of him than anything, but it was a legit triangle. I had his arm over and all that business. So, with that, let's go ahead and throw down with some music. That kind of meandered about, but so it was a good time. But yeah, this hamstring thing still got me distracted. Anyway, let's go ahead and throw down with some music. We're going to start it off with a little bit of Body Count, Ski Mask Way, First Dance, here on Coin Metal. And that was Judas Priest with Bloodstone. Yeah, trying something different out with the old seating arrangement. Seems my My hips, at least part of my problem is this chair. It's just like disintegrating under my ass. So, you gotta make adjustments. You gotta do what you gotta do to continue to get by at least. Anywho, yeah, I got a whole bunch of tabs available. Got 2 browsers open, so got enough material here. And the first one I got here is on Cointelegraph. It's by Andrew Calderaro. And apparently this was authored approximately, come on, reload, there we go, 11 hours ago. SEC tells Telegram its crypto is worth less than donuts. Who the fuck is the SEC to say anything about anything? On January 27th, the Securities and Exchange Commission fortified its case against Telegram, saying its Gram token is worth less than donuts. The SEC's counter. In the latest in their battle with Telegram and the Telegram Open Network, Tron, the SEC argued in a memo to the Southern District Court of New York, quote, Telegram offered and sold grams as securities when it promised to deliver them in exchange for funds pursuant to the purchase agreements. That reality will not have changed if the court permits Telegram to deliver grams to the initial purchasers as part of a broad public distribution, which is in violation of Section 5 and which the court should enjoin. In the memo, the SEC included a few barbs against the instant messenger service, called out Telegram for doing, quote, a two-step around the registration provisions and performing, quote, sleight of hand by fabricating the difference between a purchaser's investment in grams and their delivery of the grams, which would allow them to withhold info normally in regulatory statements. Pavel Durov's creation, the document contends, gave a, quote, straw man argument about existence since, quote, grams will never be tangible. The SEC put the frosting on when it wrote, quote, Telegram's attempt to avoid this economic truth by labeling grams, quote, commodities also fails. Grams are not commodities. Unlike gold, comic books, and Krispy Kreme donuts, commodities Telegram compares to grams. Grams have no intrinsic value. Who is the SEC to define exactly what intrinsic value is where it pertains to a cryptocurrency or crypto project? I say they are nobody. Continuing. Background. Cointelegraph reported on the start of Telegram's legal woes last year when the SEC filed an emergency action to freeze the company's sale of Gram tokens. Per the allegations, Telegram would have sold grams only to accredited investors in the initial offering, but holders could then have resold them, a violation of Rule 506C, according to the SEC. Quote, once Telegram delivers grams to the initial purchasers, they will be able to resell billions of grams on the open market to the investing public. Telegram and or its affiliates will facilitate these sales on digital asset trading platforms. Once these resales occur, Telegram will have completed its unregistered offering with billions of grams trading on multiple platforms to a dispersed group of investors. Yeah. Okay. Well, here's the problem. First, I do not believe that it is the SEC's position to weigh in on the value of any crypto project. It's really not their position. You know, they aren't the ones that decide where you put your money. You know, that's you. And if you decide that you want to invest it in a ton, hey, that's on you. If it goes through the floor and you lose your money, hey, that's on you too. If it does really well and appreciates like a motherfucker, that's on you as well. See, I think that's the part where the SEC kind of misses things is that there's always a reward to risk. And if people are willing to entertain the risk, they're not risk averse enough to stay away from crypto, that is up to them. It is not up to the SEC to say shit about it. Value is in the mind of the bag holder. That's pretty much all there is to it. If you believe it's worth something, invest in it. Don't worry about what the SEC has to say about it. Don't worry about what the CFTC has to say about it, or the FDIC, or the UN, or the EU, or the EBC, or fucking what is that? Or ECB rather. Or the PBOC. These are just people like you. When it comes to cryptocurrencies, they lose all of those little special dignitary things. Those are meaningless. The question is, do you have the funds? And are you willing to trade them? And at what price? If we can come to a agreement on that, then we can do business. That's all there is to it. Anyway, so yeah, I think the SEC needs to blow off and leave Telegram alone. If Telegram screws up and loses all kinds of people's money, or if the investors over the longer term decide it's not really worth it and decide to get the fuck out and dump it, again, it might as well be a stock on any of the exchanges, and it's really out of the SEC's control either way. Because you're not really restricted to exchanges that are registering with them. You're not necessarily restricted to any entities that are restricted by them. Because in fact, they don't do anything to generate the ton. That's on Telegram. But again, there's the question of fraud, okay? And it always comes up, and there's always the how should I say it? The specter of it. Because this is such a new investment type and commodity, money. It can be all of those things and none of those things. It all depends on what the application of it is, what the use case is. But trying to eliminate options for people when they're trying to get some sort of return on their monetary value, or at least retain it in the face of a depreciating fiat currency or other financial collapse within their country of residence, that's entirely on them. Anyway, so I do have other stuff I wanted to get into. I'm trying to find it though. No, that's not it. It's not it. Is this it? No, that's not it. Yeah, so we got SEC Telegram and cryptos worth less than donuts. We got that. Oh my gosh. And so, speaking of who has the authority to speak for you with regard to how you invest your time and your money and your bandwidth and your electricity and your hardware, got this other guy, and he showed up around 2011, 2012-ish, and he was dubbed kind of a Bitcoin messiah and whatnot because he went all around doing talks, and that was really cool, and it was really important for the initial, how should I say it, proliferation of Bitcoin as a meme at least. But he's also responsible, I believe, and I think he's kind of admitted to this at one point or another, with the proliferation of the concept of quote-unquote blockchain. So, you got to take the good with the bad there. But anyway, so the problem with people like this guy is that they kind of pass off as quote unquote experts, and they're quite knowledgeable. Mr. Antonopolous is very, very knowledgeable and certainly about cryptocurrencies, and I would not take anything away from him. However, he does make kind of omissions. He just kind of leaves stuff out. You know, he talks about the function of like time-like contracts and shit like that, but he doesn't really tell you like who is going to be doing them. You know, the assumption is it's you, right? But I've already argued on this show multiple times that anything associated with quote-unquote off-chain solutions, in the longer term, it will be there is an intermediary between you and the blockchain in question conducting the transactions for you. And this is kind of like antithetical to the whole point of Bitcoin. So anyway, got this article here. It's on Cointelegraph.com. It is authored approximately 7 hours ago. And this is by Colin Post. So yes, penis. Antonopolous writes to judge vouching for law team suing Bitfinex for BTC manipulation. One of the biggest names in crypto has joined in an ongoing argument about who will lead the class action suit against Bitfinex and its affiliates over alleged market manipulation leading to Bitcoin's 2017 bull run. Alright, I want to pause right there. The 2017 bull run, on exchanges, it might have had something to do with quote-unquote whales and manipulators and whatnot, but the fact of the matter is that it had absolutely nothing to do with what was going on with the price of Bitcoin. It had to do with people using Bitcoin or trying to use Bitcoin. Yeah, I know. Completely fucking lunacy, right? I tried to use Bitcoin at that time, or the time leading up to it, actually. And it was actually the last time that I used Bitcoin because I waited over 27 hours for my first confirmation. I waited so long that the vendor for the third-party device that I ended up having to use to get my Bitcoin cashed out, I was using one of those ATMs, Bitcoin ATMs in the mall and shit. And I did that for a little while because the fees, while being slightly higher than median, were reasonable. Okay, you know, I could pay a $1.20 fee on that at one time and get my transaction for multiple hundreds of dollars done. And hey, that was wonderful. But then, you know, it started getting more expensive and more expensive and more expensive. And the last time that I tried to use it was in the run-up to the 2017 bull run. And I shit you not, the guy, the vendor for the machine, pushed the transaction. And not only did he try to push the transaction, he also gave me the money for the transaction and basically told me to consider it, you know, finished, right? But get this, I paid a $22 fee to get less than $100 cashed out to Bitcoin. And this is before the fucking spike went all the way to actually it was before it even broke 10,000. I think at the time Bitcoin was going between it was in that range between 2 and 6,000. But the point of the matter is that I waited so long for that. I could have actually gone back and double spent it. Because I got the little message on my phone telling me that the first confirmation went through 27 hours after I made my fucking transaction attempt. And this is something that's supposed to take 10 minutes. And would take 10 minutes if Bitcoin had bigger blocks. But anyway, the assertion that it had anything to do with manipulators on the exchanges is complete and utter bullshit. If you want to know where the fucking price spike really came in, Go look at the mempool, the historic mempool chart. You'll see this huge fucking spike. And it didn't last just one day. It was weeks. And during that time, that mempool was floating well above 10, 20 megabytes, 100 megabytes at one point, and I think it was even higher than that. But that was people trying to cash Bitcoin or send Bitcoin from one person to another. And, so the assertion that it was all on quote-unquote manipulators, utter, complete, total fallacy. Go back and check the historic data. It's fucking there. I'm sure there's some sort of price chart out there for what fees cost historically. And if you look back in time, you'll see this huge fucking spike, man. It's a huge fucking mountain. And you will see how high the fucking fees got per kilobyte of block space, or per byte or per kilobyte of block space in the blocks of the Bitcoin blockchain. So, the fantasy that it was all just market manipulation. No, it was people trying to move their fucking money. Anyway, continuing on. Antonopoulos' affidavit. Amid a flurry of filings seeking to lead the class, Andreas Antonopolous has come out in support of the legal team of Leibowitz, filing an affidavit on January 27th, vouching for the expertise of the team, which Antonopoulos has seen in action on the Kleeman v. Wright case. Oh, well, no. Apparently they're completely fucking inept because they haven't been able to put that guy in jail. Because the guy's either guilty or he's Satoshi Nakamoto and they're going to put him in jail for something else. I explained this to a BSV fan the other day, that Mr. Wright has kind of put himself in this Gordian knot. And it's wrapped around his neck here. One, he proves he's Satoshi Nakamoto once and for all. And while that will free him up in some ways, it will land him in prison in others. Because there are people that will put lawsuits on him. And following up, there'll be people wanting to put criminal charges on him. Specifically with securities and whatnot. It's one of the reasons why the Satoshi Nakamoto name came into existence, was to retain the anonymity of the creator of Bitcoin. And it was so he couldn't be hunted down and fucking killed or hung or whatever, and kind of have the project deleted with them. But anyway, so Wright comes forward and more or less admits that he's Satoshi Nakamoto without really taking into account what this would mean. Okay, I think he thought it just meant that he would be able to direct shit and people would just believe him, right? And again, this is a very, very smart man. He is not stupid. I would be the last person to say that he is. Just like I'd be the last person to say that Andreas Antonopolous is stupid. I do not believe he is a non-intelligent person. I believe he's a very intelligent person. And the same thing with CSW. When I listen to him talk about cryptocurrencies, specifically Bitcoin, I get the impression he's done a hell of a lot of reading. He's done a lot of study on this subject, maybe even some programming, or at least overseen some. But at the same time, I don't think he's Satoshi Nakamoto, because like I said, I think that he glommed onto it thinking that he would be able to claim it and then be able to deny it and just walk away without an issue. But the problem is that he floated around with that recognition and association for quite a while, and the problem with that is that he inferred as much to business partners and they made decisions, and they made confidences under the assumption that he was. And if it were to be proved via his admission or otherwise that he isn't, well, then he's got a whole different other fucking realm of fraud and legal issues to be worrying about. So like I said, it's like he tied a Gordian knot here, where if he's proven to be Satoshi Nakamoto, he's going to end up in prison. If he's proven not to be Satoshi Nakamoto, he's going to end up in prison. And probably broke either way too. So, this is why there was no big rush for anybody who was involved in the original project to come forward and say, hey, yeah, I'm Satoshi Nakamoto, yeah. Because they knew there was bullets and fucking people that wanted to hang him and people that wanted to sue him right off the bat. Or at least that there would be a possibility thereof. And this is one of the things that was cool about the way that it was launched, where I and countless others all over the planet were participating in mining, and regardless of nationality or anything like that. And that's pretty powerful. It means that no one government could point to it and say, all right, we're going to get rid of it, because the fact is, if you got rid of it in one country, it's still in other countries. And I believe this is still a case with cryptocurrencies. And that dynamic has changed quite a bit too, because there's the possibility of altcoins, and we've seen that full evolution in Venezuela, where it got too difficult for them to transact Bitcoin. About when it got difficult for me to transact Bitcoin, and just like me, they started to look around for options. So, I tried Dash. Dash works really pretty fucking good. And then Bitcoin Cash came out, and it worked pretty fucking good too. Although, I got to admit, Dash works a little better. But, there's still other options. I used Verge a few times in that, and it worked, and it did exactly what it's supposed to do. So, it's one of those things that it makes me believe that regardless of what any of these quote-unquote experts have to say, they really can't tell you the future with regard to cryptocurrencies. No, but nobody probably envisioned that we'd be where we are with it. I know when I was listening to that fucking processor fan hum away into the night that I never thought it would get to this, but hey, here we are. I mean, that just seems completely fucking bonkers to me at times. But, at the same time, then I reflect on the fact that it wasn't a straight line and that we still have quite a ways to go. Anyway, let's get back to this article here. The fight to lead the class. Antonopolous' opinion on the matter is just one of the host of filings in recent weeks as three separate firms seek to lead the class, i.e., run the legal proceedings. In recent months, Bitfinex, alongside related companies Tether and iFinex, has seen 4 separate class action complaints filed against them, all alleging market manipulation and all identifying the class as anyone in the United States who transacted in Bitcoin since mid-2017 or possibly earlier, potentially a huge demographic. The first of the 4 plaintiffs was Leibowitz in October, followed by Young in November, and Ebanks and Faubus earlier in January. Earlier this week, the presiding judge ordered those 4 cases to consolidate. However, the question of leadership has remained. Karen Lerner, lead attorney for Young, argued for leadership by law firms Radis and Kirby McInerney, there we go. Telling Cointelegraph that their complaint stood out based on, quote, significant investment of resources that resulted from our rigorous market analysis. Meaning, we did our homework and we want you to pay us for it. Fuck you. In turn, Kyle Roche told Cointelegraph that, quote, our firm brings unparalleled experience and expertise to cryptocurrency litigation, while also promoting the complaint brought by Roche, Cyrulnik, my apologies, sir, Kyrulnik, Friedman on behalf of Leibowitz as, quote, the most legally sound and well-researched. Regardless of the stakes of the case, Lerner explained that the case seeks to give money back to those who bought Bitcoin in recent years. I don't want you to fucking try and get my money back. I don't want you to try and intervene on my behalf. The market go up, the market go down. This is the market. That's what it do. Continuing. Quote, this class action seeks to compensate investors in Bitcoin and Bitcoin futures for damages from paying an artificial price compared to what they should have paid if the price had not been manipulated by the defendants. Yes, I would agree with that, but only in that the price should have been going up even higher. Higher, not lower. If you really want to bring a case against Ifinex and Tether and all those guys, I would argue that you should be going for a criminal case for counterfeiting and fraud. The least of which for resolutions would be a full audit of their books and all of their assets. That would give some sort of fucking safety to the market, but no. They're going on, they make price go up so I can't buy enough Bitcoin. I need to get compensated. And they're going to the man for it. Can you believe that shit? Anyway, continuing on. The firms will have until February 7th to file oppositions to each other's motions per a January 28th order from the presiding judge, Valia. Likely, this is in order to allow the firms who filed their initial complaints only in January time to respond to the flurry of filings in the past several days. Origins of the allegations. Research by John Griffin and Amin Shams, initially published in June 2018, initially spread the theory that a single whale trading USDT on Bitfinex successfully manipulated the Bitcoin market. The researchers updated their work near the end of 2019 to specify Bitfinex as the likely culprit. As Cointelegraph reported, Bitfinex and Tether have publicly dismissed the single whale theory, as well as the subsequent lawsuits, which they called mercenary and baseless. Yes, yeah, it's been my contention this whole time that Tether has been being used to actually reduce the value of Bitcoin in relative terms in US dollars. And allow me to explain. See, they don't actually have the US dollars that they're claiming to be backing the Tether with. They do some transaction and they say, yep, this represents $300 million worth of US dollars in a bank account that we have. Or at least they said that at one time. Now they're just saying that it's US dollar collateralized fucking or what is it? US dollar based, or how would you say it? Denominated. Yeah, there we go. Collateral denominated in US dollars, but the collateral being obligations, meaning loans that they've extended to other people. You know, and they could just as easily be saying, oh yeah, we gave $300 million to those guys and they're going to pay us back in, 6 months. But the fact of the matter is that they are actually those guys, and they started up a shell company back in, a year ago or whatever. And, they didn't actually give them the money. Anyway, the point being is they need a full audit on that. Okay, but there's no investigation of that. Okay, see, I think the fact is they don't have the money, but they have the tokens that are honored by the transaction that's put on the fucking Ethereum blockchain or the Omni layer or whatever, to EOS or Tezos or whatever the fuck they're putting it on these days. They're on like 4 different ones now. And so they supposedly have the US dollars, but they don't really have the US dollars. They're just taking the same assets or the same claim for assets, and people are extending them credit based on that. And so what they do is Ifinex creates, or Tether rather, creates the quote-unquote USDT and dispenses them to a friend, say, i.e. Bitfinex. They're owned by the same company, right? So the funds don't actually even have to transfer. They could just claim that they transferred it. And so at Bitfinex, they claim that, for Ifinex's account or Tether's account, they've got $300 million worth of USDT that they are free to sell for Bitcoin, which they do. They sell them at a loss for Bitcoin. They buy up the Bitcoin with them. And they don't care if the price goes up. Because the US dollars were free. Because they didn't really have them, right? They just had the tokens. USDT tokens. And so they sell all the tokens out into the market. This depreciates the price of, or the value of US dollars versus Bitcoin. Bitcoin's price goes up. And then after that, they buy Bitcoin or they've bought all kinds of Bitcoin with it. They've sold all the USDT, and so they got this hyper valued Bitcoin, right? And so they start selling the Bitcoin at a loss. Only they don't sell them for USDTs; they sell them for USDs, and they do it at a loss because they don't give a fuck. Because the Bitcoin were free, because the tether that they bought the Bitcoin with were free. And they're trading it all on their own exchange, so they're probably not paying any transaction fees for it, or even trading fees for it, so that's free too. And so the US dollars at the end, those are free too. Only when they take those out of the market, they don't replace them with anything. And so the price goes down and stays down. If you want to talk about that end of manipulation, sure. But, I don't think they will, though. Because what it would mean is that Bitcoin is supposed to be worth in actual inflation-adjusted dollars. If you were to compare it on, according to shrinkflation. And I'll give you a good one if you need a marker for the decline of volume of something. Look at the decline of volume of Reese's peanut butter cups. I've been eating them for years and have been noticing over the last, I would say, 2 years that the chocolate is getting thinner. There's more peanut butter. And the little wafers themselves, the cups themselves, that they've gotten smaller too over time. And who was that? Max Kaiser. He coined this term shrinkflation. It means because the dollars that you're trying to pay for stuff, because you have to pay more dollars for the peanuts that you're making your peanut butter with, and the cacao that you're making your chocolate with, because those things cost you more in US dollars, you have to reduce the volume of each unit in order to be able to sell it at the same price, or only slightly more expensive than it was before. But if you count the balance in the price increase and the loss of volume, you're talking about somewhere between, I would say somewhere between 5 and 10%, maybe even higher, maybe up to 15%. 15% between less product and more expensive. But we haven't seen that happening with Bitcoin, at least not in relative terms to the inflation. I mean, it's been creeping up as it should, but the fact of the matter is that during the time that they've been doing all of these overnight injections to keep the overnight market up, Bitcoin should be going through a major spike if it were the bellwether for fiat inflation that it was back during the QE days. I mean, you can literally read QE1, QE2, and QE3, and I would say QE forever. That's another thing that this whole fucking class action lawsuit leaves out, is the Fed's action and what that does to the exchange rate between of the two currencies, Bitcoin and the US dollar. You know, I really wish people would stop talking about it as a quote-unquote price, because the two are separate units. And they're completely decoupled. I mean, there's a few things that the US dollar in its fluctuations affects Bitcoin in. And again, it's with regard to like fiat inflation, you know, prices of electricity in relative terms, and also prices of hardware in relative terms go up versus the US dollar. So that's another point. But anyway, the point I'm getting at here is that they've been chasing their tail with regard to how they're pursuing Bitfinex and iFinex and Tether. And if they really wanted to prosecute them for anything real, I think they would be chasing them for counterfeiting. Because I think if there is any kind of manipulation that could actually be demonstrated, I mean, you can see it on altcoin charts, because the liquidity that was normally going back into altcoins now was exiting as US dollars for Bitcoin that had been bought with Tether. The same trick has been being pulled since Tether came onto the market, and you know, it's just appalling to me that nobody's really addressing it on that surface. Anyway, let's go ahead and throw back down into some music. And where to go? I was talking to a friend about these guys today. I think we should go with them. Let's see here. Where's that song? Here we go. Down with the Sickness by Disturbed, here on Coin Metal. And that was Periphery with Garden in the Bones. Yeah. And so, where are we going to go next? I dug around a little bit and I managed to find this notice or affidavit of Andreas Antonopolous. And so yeah, here we go. It's only 10 pages, we can get through it real quick. I, Andreas Antonopolous, declare under penalty of perjury as follows. I am over the age of 18. I am not a party to this action, and I am a resident of the United States of America. I have been retained as an expert in this matter. 2. I base the facts and opinions on this declaration on my personal knowledge, education, experience, and documents provided to me by counsel. If called as witness, I could and would testify to the truth of these facts and opinions under oath. Opinions. Number 3. I believe that my education and experience fully qualify me to make the statements contained in this declaration. Number 4. I earned my bachelor's degree 1994 in computer science and my master's degree 1995 in data communications networks and distributed systems, both from University College London, while also working in information technology, IT. Number 5. Since 1990, I have worked in the IT sector with an emphasis on networks, distributed systems, security, and training. I have secured 3 patents for network technology inventions and have published more than 200 articles and reports on security, data centers, cloud computing, and cryptographic currencies. Number 6. I'm considered one of the world's foremost experts in Bitcoin, depending on who you're talking to, and open blockchain technology. I have worked in the Bitcoin and open blockchain industry since 2012. Number 7. In 2014, Riley Media published my first book, Mastering Bitcoin, a technical book for programmers. The book is widely viewed as the definitive guide on the subject and, to date, is the world's most cited book on Bitcoin. In 2017, Mastering Bitcoin 2nd edition was published. Number 8. Since 2014, I have published 4 more books on the topics of Bitcoin and open blockchains. My 6th book, a technical book for programmers with a working title of Mastering the Lightning Network, is scheduled to be published by O'Reilly Media in the 4th quarter of 2020. Number 9. I've testified as an expert witness before regulators with respect to Bitcoin technology, before the Canadian Senate Banking and Commerce Committee, and before the Economics References Committee of the Australian Senate. Number 10. I am a frequent keynote speaker at technology and security conferences worldwide. I have been interviewed by Bloomberg, CNN, CNBC, CBS, NBC, ABC, BBC, the Financial Times, and many more media organizations for my industry expertise. Number 11. I am one of the 5 directors of the Cryptocurrency Certification Consortium, C4, a Canadian nonprofit industry standards and certification organization. Among its other actions, C4 occasionally hosts events called blockchain training conferences, which, as the name implies, trains professionals including lawyers, certified public accountants, and auditors. I am involved in setting curriculum goals and speaker selection for these events. Every attendee can earn a certified Bitcoin professional credential if they can demonstrate proficiency by passing an examination. The Blockchain Training Conference in 2019 offered the first training workshop for the new cryptocurrency security standard auditor professional designation. I was part of the steering committee which developed the CCSS standard upon which the CCSSA examination is built. Number 12. I'm a member of the Chicago Mercantile Exchange's CF Benchmarks Core Oversight Team that reviews and oversees the application of the CF Benchmarks methodology in publishing the CF Benchmark reference rates, including the Bitcoin Reference Rate, BRR, and the Bitcoin Real-Time Index, BRTI, which are regulated price indexes used in trading cryptocurrencies and cryptocurrency futures in regulated exchanges. Number 13. I am a teaching fellow for the University of Nicosia, where since 2014 I have been teaching the massive open online course, MOOC, part of the MSc in Digital Currencies. The University of Nicosia MSc in Digital Currencies is the longest running and one of the first university graduate courses on the topic of blockchain technology. 14. I set forth additional facts about my background and qualifications, including a complete list of books that I have authored during the past several years in my curriculum vitae, attached as Exhibit A. 15. In my experience, cryptocurrencies like Bitcoin and USDT present novel and unique legal challenges, including because they are non-traditional asset classes with unique technical and financial properties. The technology of cryptocurrencies and blockchains also changes very fast, at the speed that often outpaces the speed of development of relevant regulatory and legal frameworks. Additionally, while the technologies of cryptocurrencies and blockchains share some superficial similarities with other financial technologies, they differ in fundamental ways that have very few prior analogs and are difficult to explain to non-experts. They're not very difficult to explain if you encourage people to participate in them. They are difficult to explain to people if you just want them to be end users and little whores for you that you get to snipe fees off of. It all depends on how you treat people. Continuing. Number 16. Accordingly, in my experience, as was true of the internet during the 1990s, many legal professionals struggle with the technical function and evolving properties of cryptocurrency, and therefore struggle with how pre-existing law might sensibly apply to them. It doesn't, because it's none of the fucking government's business. Anyway, continuing. 17. Kyle Roche of the Russia Cyrilnik Friedman RCF has demonstrated proficiency in these areas, unlike most other lawyers in this industry. My work with Mr. Roche has been in two contexts. Number one, as an expert witness for a matter being litigated in the Southern District of Florida concerning the dispute over the ownership of a large amount of Bitcoin, Kleeman et al. V. Craig Wright. And number two, consulting with Mr. Roche in connection with this case. Of course you think he's fucking apt. You want to be on his fucking team getting paid to represent people that didn't really ask you to do that. Number 18. In the Kleeman matter, Mr. Roche has repeatedly demonstrated an understanding of the technical and functional properties of Bitcoin, cryptocurrencies, blockchain, and their underlying cryptographic principles superior to many other attorneys. Number 19. The complaint by Roche Friedman LLP filed was one of the first examples I have seen where litigators have demonstrated an understanding of this complex and novel subject matter. As a thought leader in this industry, Ms. Roche was an invited speaker to the 2019 Blockchain Training Conference. 21. While I have not had the opportunity to work as closely with the other lawyers at Mr. Roche's firm, I have had the opportunity to review the work product produced by Mr. Roche, Vevel Friedman, and Joseph Delich in both the Kleeman matter and the matter at bar. I've been impressed with this work product and would expect them to demonstrate similar proficiency as this case progresses to serve the members of the class to the high standards of his profession. In sum, for these reasons, I believe that Roche Cyrilnik Friedman LLP is uniquely qualified to represent members of this class in this litigation. Andreas Antonopolous. Yeah, I'm not going to go into his self-jerking, which is like it reads like he's trying to apply for a job. Basically that's what this is. He's providing a lot of material that says Andreas Antonopolous is qualified to act as an expert in this case, and he'll be paid and retained and retained and paid and paid and paid. Yeah, whatever. I don't think Mr. Antonopolous is in a position to self-elect. I know people have chosen to recognize him as some big expert, but you know what? My experience of Mr. Antonopolous was this. Back in, I think it was 2015. It was around when I was first involved in doing this show, and on Twitter, while I had an account that wasn't currently suspended, I was following him, and he was talking about this big urgency with SegWit. We gotta get SegWit in. We gotta get it. All right, we didn't even have a live release for it until about close to 2 years later, 18 months, right abouts. And then the only reason we got SegWit in is because the people pushing it lied. But anyway, back to what I was saying. This was back before there was really a concern. I mean, the price for block space was starting to go up, and that's when the block space debate actually started. And the proposed solution was SegWit, which is basically, let's cut everybody's signatures out and then put that in a separate container and treat it differently than we currently do now. And there's been several accusations about what that does to the transactions and the value therein. But I'm not going to get into that. My statement to Mr. Antonopolous was this. And it was specifically because, as I saw it, if Bitcoin was to have a block size increase, 0.8 megabyte was not fucking big enough. And even then, back then, they were talking about it being like 0.4 or some shit like that. It was before it was optimized. But anyway, so I tell him, I go, if it ain't broke, don't fix it. He responded by saying to me, "You, sir, are a radical." And then he blocked me. He was the first person I know for a fact blocked me on Twitter. Now, again, this was like 18 months to 24 months before we actually had SegWit out there for people to signal support for. It was before the U8SF bullshit and all that. But for him to react that way, I mean, this guy's, supposedly beneficent, fucking head guy, Mr. Expert. And he responds that way to me. I was, what? Fuck you. This is an open source project. Call me a fucking radical and then block me like you're afraid other people are going to see what I fucking said to you or some shit. I mean, how do you want me to respond to that? You want me to think you're a smart guy? That you're due all of this deference that you're being bestowed? I think you're probably technical. I think you're very smart. But I don't think you're due that deference. So anyway, yeah, that's my opinion of this quote-unquote expert. And it'll really depend on the content of what he says to them. If he goes in as a witness or whatever, and he makes some sort of stipulation as far as like, there was one or two whales and they were doing it. If he doesn't point out the fact that the traffic on the Bitcoin network of people trying to do transactions was at an all-time high. As a matter of fact, it's never been that high since. And it was because people were paying exorbitant fees just to conduct a transaction, just to move some fucking money from point A to point B, the way they had for about 6 years before then. And everybody, this guy, he wants to, at least from my indications given by what I see in front of me here, he wants to say to the court, "Oh no, that was it went to 20,000 because of Bitcoin whales." Give me a fucking break. Anyway, this is this next article here. It's kind of exemplifies the what we see in crypto with regard to the way that top-down management styles kind of don't resonate with the people that are involved in this space. I mean, I haven't seen any victory dances when it comes to Ethereum and anybody talking about them having gone fully over to proof of stake yet. So I'm going to assume that there's still a proof of work network. Just like this one here, Bitcoin.com withdraws from Bitcoin Cash proposal to divert part of the block rewards to Dev Fund. Why would you do that? And this is authored January 28th, 2020 at 11:15 a.m. Eastern Standard Time, and it's by Celia Wan. Roger Vere's mining pool Bitcoin.com has decided not to support a proposal that aims to redirect 12.5 of the Bitcoin Cash block rewards to a development fund. In a blog post on Tuesday, Bitcoin.com said it will, quote, not go through with supporting any plan unless there is more agreement in the ecosystem such that the risk of a chain split is negligible. Bitcoin.com will not risk a chain split or a change to the underlying economics. In order to do this, any proposal will need to have as many people of economic weight on board as possible, including businesses, exchanges, miners, actually just miners, it doesn't really matter what anybody else thinks, and Bitcoin Cash implementations, the blog post stated. And you know what, but we're going to go read that here in a moment if we can, see if it actually links to it. No, it doesn't. Links to some fucking ad for their bullshit wallet. Let me see if it gives us news. I don't think it'll actually give to that. Okay. So we'll go ahead and get rid of that. Last week, mining pool BTC top CEO Jiang Zhao announced the block reward cut petition in a blog's post, stating that the move was to support the development of Bitcoin Cash infrastructure and threaten to orphan blocks that do not go with the proposal. At the time, Bitcoin.com, Antpool, BTC.com, and Via BTC all signed Zhang's petition, representing around 31.6% of the total Bitcoin Cash hash rate. Bitcoin.com accounts for roughly 0.39% of the total Bitcoin Cash hash rate. As a matter of fact, the last time that I checked, it was split three ways, and there was a lot of I think it's unidentified miners, or they couldn't attribute exactly what the pool name was, or whether they were mono miners or merge miners or what the fuck. But anyway, so yeah, there you have it. They wanted their little tax, and I don't think it's actually going to go through. We've seen this with regard to ICOs. And invariably what happens is that the development fund gets pissed away on coke and hookers and boats and hoes and shit, and doesn't actually go to development. And the developers get lazy and don't fucking do anything. So, yeah, I think it's a stupid idea. And the people asking for it, I think they're stupid. To me, it indicates that they want to keep more Bitcoin Cash off of the open market in order to try and goose the price of their coin. They want to claim 12.5% of the Bitcoin Cash right off the top, and dedicate that either to their own development works or the development works of a proxy that they're working for, or they're working as a proxy for. It could go either way, and these are all risks in this game. It's not a single surface out there. It's all what people are willing to pay for, and if one entity is willing to pay more than millions of entities, then that entity is probably going to win. But the chances of them being able to outbid millions of other entities in perpetuity is virtually nil. Eventually somebody's going to catch up to your ass. Or we will. The rest of us will catch up to your ass. But yeah, another little malady of that management style. And I really got to wonder where it comes from. I think it's because we still have governments. Anyway, this is on Coindesk.com. Most of MakerDAO's asset value is in only a few addresses. And this is authored on January 29th, 2020 at 1701 UTC. And this is by Omkar Godbol. Yes, penis. The decentralized finance market saw a massive upswing in 2019, and its growth is expected to continue into 2020. Yet, only a handful of accounts are responsible for much of the industry's value. DeFi is the movement to transform old financial products into trustless and transparent protocols that run on decentralized applications built using smart contract platforms like Ethereum. The most popular DeFi protocol right now is MakerDAO's multi-collateral DAI system, where users create, quote, collateralized debt positions, CDP, by putting up Ether or other ERC20 tokens as collateral to generate DAI tokens up to 2/3 of the value of the Ether. The generated DIA serves as a debt and can be used in the same manner as any other cryptocurrency. It can be freely sent to others, used as payments for goods and services, or held as long-term savings. Since DAI's value is pegged to the US dollar, a user only owes back what he or she initially borrowed, with interest. As of January 17th, about $400 million worth of assets used as collateral were locked up in MakerDAO Protocol Stability System, according to Digital Assets data. Let's see here. Meanwhile, the number of Ether tokens locked up in the DAI system has reached an all-time high of nearly 2.5 million, or about 2.2% of total Ether supply. The amount of DAI locked up in DeFi recently rose to $50 million, representing a 65% month-on-month growth, according to Arcane Research. The total value locked in various DeFi protocols rose above $800 million earlier this month, up over 236% year-on-year, according to DeFiPulse.com. Concentrated market. Although the DeFi market has exploded over the past 12 months, activity has been dominated by a very small portion of addresses. On the old MakerDAO protocol, what they now refer to as single collateral (SAI), approximately 155,000 CDPs were created. Yet, 77% with positive amounts with positive amounts locked held less than 0.05 ETH. $8.10 as of publication time. As of January 15th, Brandon Anderson, data science lead at Digital Assets Data, told CoinDesk. Categorizing accounts based on locked pooled Ether collateral balances just shows how large disparity is. Just one account holds 171,000 P-ETH, or 27% of total P-ETH, held on January 15th. Holy crap. A similar distribution is seen under the new system launched in November 2019, which now refers to CDPs as, quote, vaults, and where the DAI is backed by multiple collaterals. Again, most accounts are small in size. However, with these addresses holding just 4% of the total wrapped Ether, WETH, locked. Meanwhile, a single address holds 15% of the value locked as of January 15th, and another one holds nearly 8%. Essentially, two accounts were holding nearly a quarter of the total collateral. Wow. The owners of these big accounts are not yet known. Quote, neither the Maker Protocol nor the Maker Foundation track personal details of the vault, formerly known as CDP holders. It's a core component of the decentralized system, Mark Porcaro, head of communications at MakerDAO, told CoinDesk. Quote, the accounts in the lower tier vaults, lowest balances, appear to be actual adopters, with more than one Ethereum being locked into the accounts, according to Anderson. As MakerDAO continues to grow, we will see how these distributions play out and if there is more adoption within the group of smaller account balances. The concentration of ownership is nothing new in crypto, of course. It's also an issue in the Bitcoin market. As of December 2019, only 2 addresses had 100,000 or more Bitcoins, according to blockchain intelligence firm Into the Block. Most addresses held under 10 Bitcoin, and while there were only 2,022 addresses holding 1,000 to 1 million BTC, these addresses controlled over 40% of Bitcoin's total supply. Further, the top 1,000 addresses controlled 34.8% of all available coins, according to Coinmetrics. So yeah, it seems like the grandiose ideas that, we're going to have distributed ownership and it's going to be completely decentralized or whatever. It's on somebody else's wallet, basically. or like 6 people's wallets. That sounds a lot like a bank to me. Again, we see this over and over again in crypto, and I think that it's just a phase in its development that once people understand that the real value is in the volatility, in the exchange rates between coins, and that the different attributes of each coin and or tokenized asset should be relative to the users or interested parties. And I think the big confusion with cryptocurrencies is that we're still looking for the big dog to be telling us what to do. Looking to people like Andreas Antonopolous to tell us what kind of terms we should define our coins by. And I think that's a big disservice, because the fact of the matter is that there is nothing so concrete in cryptocurrency, not even now. 10 years down the line, and everything is still liquid as fucking quicksand. Go ahead and try and build your castle on top of it, but just remember, it's quicksand, and it can get sucked out from under you just as quick as it does anything else. So yeah, don't mistake it for bedrock. It is not bedrock. And I think this is kind of emblematic of the same thing. And this is on Coindesk.com. Literally no one is trading backed Bitcoin options. This is on January 29th, 2020 at 1750 UTC. And this is by Omkar Godbowl. And so yes, penis. Trading volumes in Bitcoin options listed on Intercontinental Exchange's backed platform have completely dried up, even while CME's options product is seeing strong interest. As per backed data, not a single Bitcoin options contract was traded last week on backed, with activity last registered on January 17th when 20 lots had changed hands. This is happening while the price of Bitcoin has rallied to 2-month highs, to 3-month highs, raising the cryptocurrency's volatility. Demand for options tends to rise with a spike in volatility, the standard deviation of an asset's returns that is used as a measure of uncertainty. The options contract gives the right, but not the obligation, to buy or sell the specified amount of the underlying specified amount of the underlying on or before the expiration date. A call option gives the holder a right to buy, while the put option gives the holder the right to sell. New York-based Bakkt launched the first regulated Bitcoin options contract on December 9th, having rolled out a cash-settled futures and physically settled futures November and September respectively. The physically delivered product, which went live on September 24th, was well received by markets. Trading volumes quadrupled to $4.8 million in 1 month after launch, as noted by Bakkt Volume Bot, a Twitter account that tracks the exchange's trades. The solid growth likely motivated Bakkt to offer option contracts on Bitcoin. So far, however, the uptake for its options product has been weak. Bakkt traded a little over $1 million worth of options in the first 4 weeks since the launch in December 9th. The highest contract, worth $500,000, was initiated during the second week. These numbers appear weak when compared to the Chicago Mercantile Exchange CME's first day options trading volume of $2.3 million. Trading activity on Bakkt has dwindled, particularly since the launch of options on the CME. The CME listed options on January 13th, a month after Bakkt's launch. Even so, the Chicago-based exchange is witnessing higher trading volumes, while Bakkt saw no activity last week. The CME traded 59 lots of options. For now, institutional investors seem to be preferring CME over Bakkt, which isn't surprising as the CME's 2-year-old Bitcoin futures are among the most liquid derivative products in the cryptocurrency space. While Bakkt futures witnessed a record trading volume of 6,600 contracts on December 18th, the CME futures registered an average daily volume of 6,400 in 2019. However, the difference is substantially more pronounced, given that Bakkt's contracts are for 1 Bitcoin each, while the CME's futures contract size is 5 Bitcoin. It remains to be seen if Bakkt volume will pick up, with a potential rise in price volatility ahead of the mining reward halving due in May, or if the CME will continue to dominate the derivatives space. I think that in the longer term we are going to see these third parties bail out. That Bitcoin itself will probably become too volatile for them to account for, and they'll end up getting wrecked far too many times. But that's just my feeling. I think that we're going to see some excessive volatility in the near future as we see more of the liquidity coming from the fiat side of the market into crypto. And as we do, we're going to see some ups and some downs. And when we get those downs, they're not actually going to be all that convenient for everybody involved. Not even the hodlers. But it'll certainly be worse for those who are depending on a actual return. People that are trading these futures and whatnot, they do not want to get liquidated. They do not want their positions terminated. Although I'm not entirely sure how those markets operate. Honestly, I've never even dealt with them. I've never felt that they were necessary. I mean, the reason why you use a derivative or any kind of additional abstraction on your abstraction of value is because you don't have the real thing. And one of the things noted about Bakkt is that very few of their contracts are actually liquidating out into Bitcoin. And we can tell this from the traffic of the coins exiting their wallets. We're not seeing an incredible amount of them taking off. And it could be that people are just rolling them over on the exchange. But yeah, it could just be that people are cashing them out instead of taking their Bitcoin. Anyway, let's go ahead and throw back down into some music. And as far as where to go, I played a lot of good stuff so far today. Although I haven't played any Helmet. Not a damn song by Helmet. I'm going to have to fix that. But I'm not going to play the one song that I really, really love on there. Because there are plenty of them on there. And In the Meantime by Helmet. Here on Coin Metal. And that was Melvin's with Honey Bucket. And it is with that I'd like to draw this episode to a close. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Friday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. As far as our last dance is concerned, I've been wanting to play something by 9 Inch Nails, but I haven't been able to figure out exactly which song and when to do it. And so I've got just enough time to fit this one in, and so this will be our last dance for the evening. 9 Inch Nails, Mr. Self-Destruct. Last dance here on Coin Metal. Thank you again for listening, and you all have an excellent evening. Good night.